Good afternoon, everybody. We are starting with our Facebook Live program on Tax Adda. Can I request Ameet to come and join me here at the stage? Let me start by pointing out why we are doing this. We have been recently flooded with queries on taxation, on personal taxations in the tax helpline that we run in Moneylife Foundation. It's been a great learning experience. We have had tremendous support from people like Amit, Nikhil Wadia, Amir Kunte, Subodh Shah. All of them have been sort of replying very generously, sharing their time with us to answer these questions. But there have been just too many questions. We've just running a huge backlog of questions, and we didn't want to burden them, with these questions. So we thought we'd take a shortcut. And that would be just run these questions by somebody like Mr. Patel this afternoon, maybe Nikhil next time. And at one stroke, at one go in over a couple of hours, we'll just sort of reduce the number of backlog that we are currently running to a more manageable level. Then, of course, the questions keep increasing. So that's why we're having this Tax Adda today. The format is very simple. I have already pre-selected a list of questions which are quite old and also quite complicated. So that was the selection criteria that we took. And we had sent these questions in advance to Amit, and we thought we'll compress the time in terms of getting him to quickly review them and come and reply. But he's taken the trouble of actually putting down all the answers, so we can actually ask even more questions. So he's already gone through them, he knows what they are, the complexity and so on. Before I get on to it, let me introduce Amit formally. Those of you who are attached to Moneylife Foundation would already have seen many of the programs that we have done with him. He's a brilliant chartered accountant, he's a rank holder at the All India level, and he's been in private practice right from the beginning. Currently, he's a partner at Manohar Chaudhary and Associates, and spent a large part of his professional career dealing with taxation matters. And in the past few years, he's focused on tax matters of FIIs, banks, mutual funds, qualified institutional investors, and so on and so forth. He is an independent director and member of the audit committee of LIC Housing Finance Limited, one of the largest housing finance companies in India, and he's been actively involved with the activities of Institute of Chartered Accountants of India and also the Bombay Chartered Accountants Society. So with these few words, let me just get on to the questions this afternoon. Thanks. We will target to have about 20-25 questions today, depending on the time, and we can, if we still have some time, we can sort of take questions from the audience over here. My first question is would be something that will resonate with a lot of people, which is regarding paying stamp duty. The question is, I had purchased e-stamp of 2.84 lakhs for registration of a flat. However, I changed my mind and I upgraded to a bigger flat. I now need to return the stamp paper and get a refund of 2.5 lakhs. Will this refund be taxable? That's the question.
Yeah. So, first of all, thank you Debashis and Moneylife for this very interesting Tax Adda. This is my first experience of being part of any Adda for that matter. And let's see how things go. You mentioned that the criteria for selecting the question was that they should be complicated. I don't know of any question relating to tax which is not complicated. So for us, all questions are similar in complications. But my personal feeling is that most questions which have been asked or which could be asked in future by common citizens of the country are primarily arising because of ignorance of the law, ignorance of the Income Tax Act, of the provisions, etc. And this is where the people of India must realize one thing, that it is foolhardy to neglect the provisions of the law, whether it is Income Tax Act or any other law for that matter. One needs to take proper advice and then take steps. Invariably what happens is that people take the steps and then go to a chartered accountant or to a tax consultant and ask now what to do.
After getting the notice.
Exactly. So the better thing would be to first take advice and then execute a transaction or take steps in any particular matter. So with that very brief background, which will give you an idea about how I will be replying to the questions. Let me deal with the first question about refund of stamp duty paid by someone. And this would apply not merely to stamp duty but to anything that you make a particular payment and you are getting it back for some reason, for whatever reason.
Right.
Will that refund of that money paid by you earlier be considered as an income? So the answer is very clear that unless any receipt that you get into your hands is of a revenue nature, as per the Income Tax Act, there is no question of offering it for tax or no question of the income tax officer trying to tax it. In this particular specific question, the querist has asked about stamp duty paid through electronic medium. The medium is irrelevant. The fact is that that person has paid some stamp duty, the transaction probably got cancelled, and now that person has to apply for a refund. Right. In this case, when the payment was made, probably no deduction was claimed under any of the provisions of the law as far as Income Tax Act is concerned. And that being the case, when you get your own money back, the question of taxing that money does not arise. Right. So the short answer to the question is that no, the refund of the e-stamp duty paid will not be treated as income. The only caveat to this, and again this would apply to a few questions which will come up in the next few minutes, is that if this stamp duty was part of a transaction of buying an immovable property, and maybe the transaction has gone through, the refund of stamp duty is on account of some other reason, and the taxpayer has claimed any tax benefit for that stamp duty,
like ATC or something.
ATC, then there is an issue. But provided he has not claimed any tax benefit, the question of offering it for tax doesn't arise.
My next question is from an NRI, and we keep getting a lot of questions from the NRIs. For them, it's quite a difficult life. They have to take care of the taxes of the country in which they're working and also of the Indian laws. This question is simpler than the other complicated ones we get. And one thing I must point out in this tax helpline is that we cannot offer answers to questions that are very complicated. It's not fair to expect Amit and other experts to spend their time giving replies for which the querist should seek professional help. So that's one of the reasons that we do not reply to all questions, right? Jubin Sam, who works in the Gulf. I have only my salary as income from outside India. Do I need to declare? I have no taxable income from India.
Yeah, so again, this is, as you rightly said, it's a very common question. A lot of non-residents keep on asking these questions. Before answering this specific question, I would like to first talk about something which is very generic in nature and which applies to non-residents. Most people who are living outside India get mixed up between the definition of non-resident as per Income Tax Act and non-resident Indian. This querist has said that I am an NRI living in the Gulf, etc. So NRI is a term which is actually not defined anywhere. It is the common perception of an NRI is under the Exchange Control Law, that is the Foreign Exchange Management Act. So there is a definition of non-resident Indian under Foreign Exchange Management Act, and there is a definition of non-resident, which could apply to an individual or to a company or to a partnership firm, to any entity
under the Income Tax
Act. So when someone asks a question relating to taxation, one needs to be careful as to, please be sure whether you are a non-resident under Income Tax Act also, apart from being an NRI under the FEMA. It is possible that someone who is an NRI under FEMA is not a non-resident under Income Tax Act. So in this case, presuming that the person who asked the question is a non-resident under Income Tax Act as well as an NRI under FEMA. Of course, for Income Tax Act purposes, FEMA is not relevant, so as to speak. But presuming that he is an non-resident under Income Tax Act, then what is to be offered for tax in India in his Indian tax return is only the tax accruing or arising in India or income which is received in India. Right. If he is a salaried person working in the Gulf and getting salary from a company based in the Gulf, obviously the salary would be accruing outside India. In all probability, it is also received outside India, and in that case, there is no question of offering that to tax in India. Right. If that income is not taxable in India, and if he does not have any other income in India, then obviously, statistically, his income, as per Indian Income Tax Act, is below threshold limit, and therefore he does not need to file any tax return in India.
We've seen in a lot of cases nowadays the consumer is able to get compensation for delays in construction of apartments. And then actually consumer courts, high courts, even Supreme Court has been coming down on the builders and giving very high compensation to consumers who have been not given property in time. One question relates to that, which is our builder has given a compensation for delay in handing over the apartment. He wants to deduct 10% TDS, which means I am bound to pay an additional 20% while filing returns. I received 1 lakh as compensation from the builder, but may have to pay an additional tax. Kindly clarify, what does the rule say?
Yeah, so this is one good positive fallout of the RERA also. Yeah. People are now starting to complain to the government. The government is actually taking action, yes. And therefore the consumers are benefiting by way of compensation from builders. In all these cases, whether it is a case of compensation or I may even transgress and go into other areas, say in case of redevelopment. You get a compensation from the builder, which is called, sometimes it is called corpus donation, sometimes it is called hardship allowance, sometimes it is called hardship compensation, etc. And you get various other types of compensations. What is most important in any of these kind of scenarios is what is written in your agreement. Every builder will have their own lawyers advising them on the draft of the agreement. Generally, the buyer does not have any say. He is given a big 200-page document and told to sign at maybe 100 places. And finally, he doesn't even know what he's signing. He keeps on signing everywhere and gives it out. But one must therefore look at the clauses which deal with these kind of damages or compensation which a builder needs to pay.
I would assume there would be no such clause.
No, there would be invariably there will be clauses. When you are buying a house, there will be a clause, because I think it is mandated probably by law. I don't know about that, but there are clauses which say that if the possession is not given within, say for example, 36 months or 60 months or whatever it is, the builder will pay interest of whatever, 12%, 15%, 18%, etc. to the investor. So these clauses are there invariably. One needs to therefore see what is the clause in this particular case. If it is drafted in a manner that it appears that it is like a compensation or a damage, then it is treated on a different footing under Income Tax Act. However, if the agreement itself says that builder will pay say 15% per annum as interest, then it is clearly interest, in which case it would be a taxable revenue receipt in the hands of the purchaser of the flat. So therefore, most important thing to be seen in this case is what is written in the agreement. Now, presuming that there is nothing in the agreement and this matter has gone to the court and it is because of a dispute, a legal dispute and a fight, a bitter fight
awarded by the court,
then one needs to look at what the court has written in the order. If the court says that no, because of this the buyer has suffered and he has had to pay interest, etc., so the builder should pay interest to him, then it's clearly interest income. Interest income received in this kind of a situation would need to be offered for tax in the return under the head income from other sources. And as is rightly said, because and the fact that he himself has mentioned that the builder is going to deduct tax at 10%. Now the 10% TDS rate applies to interest payments. So therefore the builder himself is treating it as interest payment. Now when the payer of the income gives a particular nomenclature, for a common man, I'm not talking about a businessman who has got the infrastructure to argue and fight, but a common man will find it very difficult to not treat that as interest, because his interest will get reflected in his form 26AS. There will be a TDS 194A section will be mentioned in the 26AS, and if that interest, that entry in the form 26AS does not match with the entry in his return of income under the head income from other sources, there is every chance that he will get a question from the income tax department.
But the bigger issue remains, increasingly just assume that the courts are, forget the real estate issue. Suppose the consumer court has given an order of a compensation for something that I have suffered.
Yeah.
How do I treat that?
Yeah. So if it is like a compensation for say a hardship cause or for defamation, there are a lot of politicians who are getting all these.
We got some.
Exactly. But I wanted to refer only to politicians. So if the court orders a compensation in such cases, then there is a good case for taking a stand that it's a capital receipt. And capital receipts are not taxable. What is taxable is only revenue receipts. Only exception being capital gains, where you sell a property, it is a capital receipt, but there is a specific head of income dealing with the taxation of that income.
Interesting, because the court cases that I've seen of consumer court, all is about lump sum compensation, not about interest.
Correct.
So mostly it would be capital receipt.
So I would take a stand in those cases that it is not taxable.
But in this case, that person will have to fight it out and all of that.
And in this case, it appears that it is interest because he is deducting 10%. Of course, the builder may want to protect themselves. Builder may want to claim a deduction for that interest, so he is taking a safe side and deducting under 194A.
Right. The next question is quite bizarre. Recently, while filing returns, my friend realized that someone has also been issued by the same PAN number. The other person has also linked his Aadhaar with that PAN number, and therefore my friend is unable to do so. And always these cases are of a friend, not the querist. Moreover, he is worried that the tax return is about to get, that is 20,000 rupees from the IT department. Now, is this a credible case? What is your answer?
I am completely shocked that such a situation has arisen. According to me, technically it is impossible because the PANs are issued by a system.
Right.
Their numbers are system generated, and obviously the system will be verifying all the the digits of the PAN before issuing the PAN to anybody. So the question of a duplicate PAN and same PAN being allotted to two persons, according to me, technically it does not arise. Presuming that it has happened for some reason or the other, there are two options, there are two possibilities. One is that it is a clear mistake, it is a one-off case and a mistake by the system. Other could be a fraud. In either case, according to me, this person should first file an FIR in the nearest police station saying that somebody seems to have perpetrated a fraud by taking my PAN in his name and lodge a complaint. Then he should also place on record with the income tax department the complaint that this is my PAN, but it also appears to have been issued to somebody else, and let the department find out what is the situation. He should also place on record that some income tax refund has been determined as payable to me, whereas I have not claimed it. My return copy is here. I have not claimed any refund of that amount, and therefore disown that the refund clearly on record by taking an acknowledgement from the income tax department, and then take it up at the commissioner level. Okay. But according
it's a very serious matter.
Technically, it's impossible, and because it has happened, and especially today when there is so much of hue and cry, particularly about Aadhaar card, etc., everything is interlinked.
Right.
So this is a very, very risky situation.
I am a state government employee and I invest in stocks. I had a loss on sale of stocks that I decided to declare in ITR 1. Do I have to file any other ITR, and is offsetting loss of stocks under the head income from other sources in the ITR 1 correct?
Right. So, first of all, he is a government servant and investing in stocks. So, for people like you, I'm sure it's good news that the equity cult is spreading far and wide. A lot of people are investing in the markets, and we hope that the achhe din will come at least on the stock market.
It's already come.
As far as the capital gains is concerned, I think the person has made a clear mistake in selecting ITR 1. ITR 1 is not available to someone who has capital gains.
Okay.
So ITR 1 can be used only if you have salary income and income from other sources, and the person is only one house property.
Okay.
If he has capital gain, he should have used ITR 2. So the first of all, the ITR used by the taxpayer is wrong. Secondly, he has asked about, I think, a set-off of the losses. As far as capital gains is concerned, or rather losses under the head capital gains are concerned, one needs to be a little careful over here, because in the normal course, loss under any one head can be set off against income under any other head in the normal course. But capital gains is an exception to the normal rule, where it says that first of all, any capital loss cannot be set off against any other income. So for example, if somebody has salary income, has bank interest, and a capital loss, a loss by selling, say, I don't know how somebody can make a loss. Generally in property there will not be a loss, but presuming there is a loss under the head capital gains, and there is a positive salary income, positive bank interest, the loss cannot be set off against either the salary or the bank interest. You need to have any other capital gains only to set off the capital loss. That is the first general rule for capital gains. Then there is a specific rule for capital gains, that if you have a long-term capital loss, it can be set off only against any other long-term capital gains. You cannot set it off against short-term capital gains. If you have a short-term capital loss, on the other hand, unlike long-term loss, the short-term capital loss can be set off against either short-term capital gains or long-term capital gains. So these are the rules as far as the set-off is concerned. And if after doing this set-off in that particular year, if some loss remains unabsorbed, because you can't set it off against any other income, any other head of income, then you have to carry it forward to the subsequent years, and so on and so forth. Up to 8 years, 8 subsequent years, you can carry it forward. But one thing is very important here, and those who are not very particular about filing the return within the time given need to be very careful. If you have a loss, whether capital loss or business loss, unless you file your tax return in time, that is by 31st July in case of non-business, and in case of non-auditees, and 30th September in case of companies and tax auditees, the capital loss will not be allowed to be carried forward to the subsequent year. So one needs to be careful about that.
One more question from somebody who's abroad. I'm working abroad. I have an NRE account in India where my salary gets transferred. My income is tax-free in India, and I'm buying a house in Haryana. Do I need to pay TDS and fill up Form 16B?
Yeah.
And additional question on GST, which I'm not asking.
So yes, sometime couple of years back they brought in this new provision whereby anyone buying a property where the agreement price is more than 50 lakhs is required to deduct TDS at 1%. It applies to any resident, anyone who is buying it, whether he is a resident or a non-resident. The only criteria is the seller has to be a resident. So if this person is buying, even if he is a non-resident, it doesn't matter, as long as he is buying from a resident, and resident for this purpose is not like NRI under the FEMA, it is resident under Income Tax Act. So if the seller is a resident, the buyer, whether he is an NRI, non-resident or a resident, has to deduct tax at 1%, and therefore thereafter he or she will have to issue the TDS certificate in that particular form.
Right. I am doing FNO trading besides regular job. Since trading in FNO is considered as a business income, to get tax rebate, can I pay monthly salary to my wife who is assisting me in trading? To claim tax on salary paid as business expenses, is the bank statement of money transfer itself enough, or is there any other formalities to be maintained?
So if the wife was really helping in the trading, the question should not have arisen, because any business expense, genuine business expense incurred for the purpose of the business is an allowable expense. So the general rule for a businessman is that if there is any genuine business expense.
Can I ask something before that?
Yep.
I am doing FNO trading besides a regular job, so that FNO can be speculative income in the eyes of tax department.
Okay, so I'll answer that question first because that is an interesting one. Ultimately, what is F&O? F&O is, there is nothing that you get in hand. When you buy shares, at least earlier we used to get the papers, now we get the entry in the Demat account. But there is an asset. Whereas in F&O, you are just buying something, futures or option. There is no real physical asset, which they are just derivatives. Yeah. So there is no asset for which you can take delivery or give delivery. So under the Income Tax Act, in a particular section, it is mentioned that where any contract for buying or selling is settled otherwise than by giving or taking delivery, then that can be considered as a speculative transaction. And then now somebody will ask, so what's the big deal? Whether I'm doing a business, normal business or a speculative business, what's the big deal? The big deal is that there is another problem, that if there is a speculative business loss, then that business loss cannot be set off against any other income. It can be set off only against speculative business profit. So that is one. Now your question is, if this person is doing F&O business, will it be treated as a speculative business? The answer to that is no, because there is a specific exclusion to the general rule that if you do not give or take delivery, it will be treated as speculative transaction. There is a specific exemption or exclusion that F&O transactions will not be considered as speculative transactions. So they have carved out the F&O transactions from the definition of speculative transactions. So it will be treated as a normal business. Now, so coming back to the question of deductibility of expenses, any genuine business expense incurred for the purpose of the business, provided it is revenue in nature, and more importantly in this case, provided it is reasonable, can be claimed as a deduction from the business income. So here, so one is salary income, a salary payment. Can salary be allowed as an expense? Of course it can be allowed. Everyone has, any businessman would have employees, would be paying salary. So the salary will be, claimed as a business expense in the profit and loss account. This person who is doing F&O business will also have to prepare a profit and loss account. He will have income hopefully from F&O on the one hand, positive income, and against that he may have genuine business expenses. For example, brokerage paid to the brokers. For example, stamp duty paid on the transaction to the broker, etc. The service tax on the brokerage, etc. STT, all that will be allowed as deductible expenses. Right. As far as salary is concerned, I would say he should err with caution. First of all, in an F&O business, I don't know what help you need from any employee. What is that employee going to do for you? So the onus of proving that there is a genuine employee working for me and doing some work will obviously be on the guy who claims that he has an employee, on the taxpayer, on the SSC. And if that employee happens to be a wife or a close relative, close family member, the onus will be even greater and the pressure will be even greater, because it is obvious. Everyone is a human being at the end of it. The ITOs are also human beings. They all know what people do.
They've seen so many such cases.
Exactly. So they've been there, done there. So expecting an ITO to believe that your wife is helping you genuinely in your business and this salary is being paid by you to her because of the efforts that she puts in, the chances of him believing that are low. The onus will be definitely on you to prove that. But if you are able to prove with documentary evidence that the wife has actually done work, then there is no reason why the salary cannot be allowed as an expense in the normal course. But the problem here is that there is another section in the Income Tax Act which deals with clubbing provisions, and which says that any salary, interest, etc., paid by a husband, paid by a taxpayer to his or her spouse, will be clubbed with his income or her income. So in this case, presuming Mr. A has paid salary to Mrs. B, his wife, even if that expense is allowed, that her income will be clubbed in his hands. Unless the wife is able to prove that she had technical capabilities to be able to earn that income. You are getting into muddy waters. I would rather not claim that 10,000-15,000 rupees as a deduction per month. I would rather, figure out what else can be done. I would definitely not advise the claim of salary paid to a wife. But presuming that, he still wants to be genuine, let's take a genuine case. So his question is what precautions to take. How do you establish that the salary is actually paid? So the first thing is that always try and pay all expenses by check through banking channels, basically. Not only check.
No, his point was that is the bank statement of money transfer itself enough? Obviously,
yes,
other documentation is
correct. So first of all, I'm saying pay by check or pay through banking channels. So you have a trail left behind. Bank statement is a good trail, but sometimes bank statement don't give the name. So how will you prove that a debit which is there in the bank statement necessarily is by way of debit to the wife? So better would be to keep vouchers, self-generated vouchers. You get ready-made voucher pads from any stationery store. Buy that, take the signature of the wife on a monthly basis, and keep that along with all the details filled in like check number, etc. In that voucher, and keep that.
Copies of the check.
Copies of
Sir, one small question. In this case, suppose the wife is filing a return, income tax return separately, then also this will apply?
In fact, I would say that if the wife is not filing the return, I would take it contrary. I would say if the wife is not filing the return, then it will be very difficult to establish the genuineness. If the wife is filing, presuming the wife is filing, it helps. Definitely it helps. But what happens based on my experience, in these kind of cases, the salary paid will be 10,000-15,000 a month, which does not lead to taxable income. So invariably in this kind of cases, what happens is, it also happens in the case of rent, for example. A salaried person gets HRA, wants to claim exemption, so pays rent to the father, pays rent to the mother, to wife, sister, all human relations go on the side, people start charging rent from their family members, Invariably, the planning will be that the rent income, which is paid, is below taxable. 2,40,000, 2,35,000, or whatever it is, will be below taxable in the hands of the recipient. So recipient does not need to file the tax return. People are a little afraid of filing a return, So that return may not be filed in most cases. But if the return is filed, it certainly helps.
And the tax department knows that 2,40,000 when they see. So quite apart from knowing the basic tax laws, we should also start thinking in terms of how the ITO will perceive our numbers.
Absolutely, absolutely. In fact, at one of the Moneylife talks, I had mentioned also that when you are dealing with taxation, first put yourself in the shoes of the tax man. You are already a taxpayer. You need to figure out how that fellow is going to think. We all heard on 8 November 2000 and what was it? 16. Yeah, that cash put into your bank account up to 2.5 lakhs or whatever it was will not be questioned. 2 lakhs, I think it was. And then what happened? Subsequently, questions have been asked from people who have put in, certain amounts of money. So one needs to be very careful. Everyone knows. People put in exactly 2 lakhs. People put in exactly 1,99,900.
Thinking they are very smart.
Neither is the Prime Minister a fool, nor is any of the guys who are sitting. Forget the income tax office. The people who are looking at the data. Today data is king. Mukesh Ambani has gone on record saying that data is the next oil of the country. So data is there. The hard facts are there. The guys who are analyzing the data are not fools. Certainly they are not foolish.
Next question on capital gain account. I have opened a capital gain account which I want to use to build a house on land owned by me. Once the house construction is complete, will the tax authorities do valuation of the constructed house to verify that I have used the entire capital gain amount for construction? Do I have to maintain individual bills of payment made to contractor and material purchased?
Absolutely. I think this is a good question because most people would be not paying attention to these matters. When you open a capital gains account scheme for claiming the exemption under section 54 or 54F, either of the sections, the money gets locked into that account for the next 3 years, and within that period you need to use that money only for the purpose of buying or constructing a house. And when you want to withdraw money for paying to a builder, or if you are constructing yourself to pay to the contractor, there is a form that needs to be filled up and given to the bank, which probably this fellow is not aware of. So that form will require the depositor to give the details of to whom the payment is being made. So the banker will take a reasonable safeguard to find out whether you are issuing to a shopper stop or whether you are using to a DLF or to a Rhoda builder, basically. So at the time of withdrawal itself, there is a reasonable safeguard kept by the Income Tax Act to ensure that the money is not used for other purposes. Having genuinely used the money for the purpose of buying the house or constructing the house, the chances of that valuation being questioned are very remote. Generally, it does not happen. In 1 out of 100 cases, if there is some suspicion, some evidence in the hands of the tax officer, concrete evidence, only then, that also with prior permissions of the higher ups, they can go and question it. But otherwise, in the normal course, that doesn't happen.
Next question, quite hilarious. We are staying in Middle East for over 10 years. Friends or relatives usually take money from us withdrawn from NRE account, but when they return it, it is deposited into NRO account. Do we have to pay tax on this? Will there be any problem which can be avoided in future?
So again, first of all, let me clarify that I'm not getting into the FEMA related matters, whether you can deposit your withdrawal from NRE into NRO or vice versa. That's not a tax matter, that's a FEMA matter. Today, being a tax adda, will focus only on taxation. And this is interesting not only for NRIs, but for anyone sitting here or anyone else who's listening today. Don't give loans in excess of 20,000 by cash, period. If you give, if somebody accepts loan, rather, it's the other way around. If somebody accepts a loan exceeding 20,000, otherwise than by an account paid check or otherwise through a bank, otherwise than through a banking channel, it is a contravention of one of the sections of the Income Tax Act, and it is not permitted. And similarly, repaying the loan. So you can neither give a loan nor receive back a loan, otherwise than through banking channels. Now, the person who has asked this question sort of has not given details of how the loan has been given, but he mentioned withdrawn from my NRE. So I hope it's not that he is sort of handed out checks to all his friends and relatives and they went to the bank and withdrew money. That would be disaster. So first thing is, don't give loans except by check. Secondly, the same principle which I spoke about earlier, that unless the payment resulted in a revenue expense which you have claimed, the question, when you get back the money, there is no question of that being again taxable in your hands. Same thing will apply here. When you give a loan, you're not claiming any expense, it's not a revenue payment. So therefore, when you get it back, there is no question of that the returned money being treated as income. So when a loan is refunded by somebody else, it does not become your income. So that is the second thing. Third is, there is this confusion about NRO and NRE. The exemption available under Income Tax Act is not for the amount in the NRE account. It is for the interest on that amount in the NRE account. So when the bank credits interest on the balance lying in the NRE deposit, that interest is exempt from tax. So suppose I have 1 crore in my querist has 1 crore in his NRE account. That itself is not taxable. But when interest on 1 crore is credited by the bank, that interest is exempt. That 1 crore, if it is used for buying some asset, it doesn't mean that because it is from an NRE account, that asset is also exempt and when I sell it, there will be no taxable profit. No, it doesn't work like that. When you sell that asset bought from the funds lying in an NRE account, we have to see the taxation of the income arising from that asset. If it is, for example, if he has bought shares and they are long term and he sells long term capital asset in the form of equity shares, then that capital gains is exempt under a different provision of the Act. So that will be exempt. But on the other hand, suppose he bought a house and he sells the house after 3 years or 5 years and there is a profit or capital gains on that, that will definitely be taxable. Just because it is from NRE account doesn't mean it is exempt. And
it's a new character.
Yeah, and the same way for the NRO account. Balance in the NRO account is not taxable or exempt. It is the interest on the balance which is taxable. So that difference between the principal amount and the interest amount needs to be understood by the people.
I bought one flat in March 2011 and another one in June 2017. Can I use the proceeds from the sale of the first flat bought in 2011 to repay housing loan on flat bought in last year? Do I still have to pay capital gains tax?
Yeah. So this is again, it happens often that you sort of you bought a house with a loan and then you sell another house. Now, presuming that everything is long term, you mentioned also that the flat was bought in 2011 and then sold. Yeah. So it is a long term capital asset. When you sell a long term capital asset in the form of a house, there is a long term capital gains. Under section 54, you can claim exemption in case of this kind of long term capital gains by investing in another house property, residential house property. And there is a time given for investing. It is, if you are buying a house, you can buy it 1 year before or 2 years after. And if you are constructing a house, you have to construct within 3 years after the sale of the house. So the very fact that you have the Income Tax Act itself allows you to say that before I sold this house, 1 year before, within 1 year before that, I have bought another house and I can claim exemption. So it is but natural that when I bought that house earlier, it is out of some other funds. It could be my own funds, it could be borrowing from a bank or from wherever. In either case, the taxpayer can certainly claim exemption in respect of the long-term capital gains on the house sold in 2017 by saying that within 1 year, provided of course the conditions are met, if you meet the conditions, you can certainly claim the exemption. Again, the caveat is that if you have taken tax benefits in respect of the housing loan, which you are now repaying, then there could be an issue. But those are getting into more detailed facts that one needs to say. But in principle, there is, the Act itself envisages a situation where you have either borrowed money or put in your own money in a house and then sold your old house.
I had taken a loan of 10 lakhs from HDFC Credila for my son in Germany. He now wants to clear the loan by sending money back into my account. Can he do it? Will I have to pay any tax on this? This is also a very, very common kind of a question.
So I have no idea what is HDFC Credila, but
it's an education loan company.
Educational loan. So the father has taken a loan. The son has gone abroad for education. Lucky with God's grace, he started earning, and now the son is returning the loan, but basically. What has to be seen in, and this is interesting because forget the resident, non-resident scenario here, it could be even locally. You know, people staying in India take loan from each other and, or rather, I take a loan to educate my child in India itself, and then my daughter repays the money instead of my repaying the money. I think what people need to understand is that if I take a loan, in the lender's books, it is me whose name appears as the borrower. Okay. So therefore, technically, the ideal situation would be that the person who is actually repaying, meaning in this case the son from Germany, should send the money to the father and deposit the money in the father's bank account, and then let the father repay the loan.
I think that's what he said.
Yeah. So that then the facts are very clear, the records are very clear. Okay. The question which this person may very well ask is that when the money comes into my bank account, that is the father's bank account from the son, how do I show it? Obviously, presuming that the son doesn't want the money back, then it's a gift. So the father can show it as a gift from the son. There is no tax implication because gift from a relative is it is an exempt receipt without any limit. Without any limit, and so you treat it as a gift and then you repay the loan.
I have old shares, people do all kinds of things. I have old shares purchased in 1998 in joint name with my brother and my name is second. Can I sell these shares from my account and claim capital gains tax benefit?
This is a very fundamental issue that most people are getting confused about, or most people are blissfully ignorant about. Therefore, I would like to sort of take some time on this. This question is talking about shares, but it could very well apply to any asset class. In India, it is customary to buy generally any asset in joint names. So bank account also would be in joint names. Demat accounts are in joint names. A house is bought in the name of husband and wife, or father, son, etc. Invariably, I'm not saying always, but invariably the money is paid by one person, but the asset is bought in joint name. So the second person, or even where there are three, then the third person also has not really paid any share of the cost of the asset, but only the name is added, generally for security purposes, for inheritance, succession, etc., for convenience basically. So if the first owner expires, the transmission of that asset does not get into a problem, because we know in India it's so difficult to convert to get a single name asset transferred to a legal end. So therefore, for convenience purposes, a lot of people buy assets in joint names, and then they ask question that can I sell, or can my brother sell, or can my wife sell, or can my father sell, etc., whoever is a joint holder. The basic issue over here is that for tax purposes, what is relevant is the beneficial ownership. Who is the actual beneficial owner? Who should be entitled to the benefits of that asset? The person who has paid for the asset is the beneficial owner. So what has to be first established is who paid for the shares. The Demat account may be in 10 names for all you care, but that doesn't mean all 10 are entitled to the capital gains. Yeah. So if the Demat account is in, say, name of A and B, the cost of the shares has actually been paid for by A. Then at the time of sale, the capital gain has to be shown in the hands of the Mr. A entirely. There is no question of showing 50-50 or 60-40 or 70-30 or 0-100 in B's name, because he doesn't own from a beneficial perspective, he does not own the shares. So anytime an asset is held in joint name, you should be very clear as to how much is each co-owner's share. There can be two co-owners, but the share can be 0-100% or 100% and 0%. It could be 99 and 1, or it could be 50-50, whatever. But unless both the people have contributed to the cost, the question of saying that other person, can I show the capital gain in the other person's name, does not arise. When you are buying a house, for example, and a lot of people, lot of these kind of cases are coming where husband and wife both are working now, both are earning, they both pay for the house, they both repay the loan, jointly. Sometimes the husband pays, sometimes the wife pays. The best course, the ideal course of action in these kind of cases would be to put it down in the purchase agreement itself that the house the purchasers are Mr. A and Mrs. B in equal proportion, or 60-40 or 70, whatever it is the actual proportion. If the proportion is laid down in the purchase agreement itself, and I don't see why any builder will not agree to do this, because for him it doesn't matter. Here we are talking about the buyer and not the seller. So the buyer will agree according to this. So put down the ratio of ownership in the agreement itself. That will make life very simple at the time of sale.
But even if the husband and wife are paying back a loan, home loan, let's say in 70-30 proportion, won't both of them get Section 10 and Section 24 benefits?
Absolutely, yeah. As long as, so now why would I repay a loan? I would repay a loan only if I am an owner of the house. Correct. So the fact that the wife is repaying some portion of the loan, say 30%, 1 lakh of EMI, 70,000 husband is paying, 30,000 wife is paying, which means that 30% of the cost is paid for by the wife and 70% by the husband. So when thereafter, even the maintenance generally should be also paid in the same proportion. And then therefore, when you sell the house, the capital gains will also be shared in that same proportion. And all the tax benefits, as you rightly mentioned, on the housing loan, the principal repayment as well as the interest payment will be allowable to both the people.
Which is in a sense an exception, because in case of capital gains, you can only get your share. So if you paid for 30% of a house, you're going to get 30% exemption.
Correct. Yeah.
It's like a double benefit which income tax is.
Not really, because there is an upper limit. At the end of it, there is an upper limit. Under ETC, what is the limit? 1,50,000. Today, in a city like Mumbai, if you buy a flat of whatever crores, that EMI is going to be far greater than 150,000. Interest on loan 2 lakh.
2.5, 2.4.
Exactly.
Then also, 100% and 0% while purchasing the house, it is permitted to mention that.
So you can, you can't write 100 and 0. What you write is that, so you mention that the Mr. A is buying the house, but for convenience purpose, the name of Mrs. B is added.
Now, this is a question, another question which involves a builder paying a compensation. A court has directed the builder to pay interest on principal of money I paid. I also paid EMIs of 14 lakh over 4 years. What happens to the interest amount that I received from the builder? Will the EMI that I have been paying be considered while calculating tax? Is there any way I can save some money from tax? Also, can I claim exemption from the lawyer's fees from the interest income?
Yeah, so this question basically deals with a fundamental principle involving tax law, that what can I deduct from my income? The basic rule is that if any expense is incurred, and this rule does not apply to salary income, it applies to all other heads of income, that if there is any expense incurred to earn that income, then that expense is allowable, provided it is revenue in nature, reasonable, all that genuineness, all that is a very common, is a basic principle. But expense incurred to earn an income is allowable as a deduction. In this example given, the buyer of the house has paid interest on the housing loan. The loan is taken to buy the house. The loan is not taken to pay to fight a case to get interest from the builder. The loan is taken to get a house from the builder. That is one. On the other hand, he is getting interest from the builder for whatever, for delays, for hardship, or for whatever, as per the court order or without the court order. So if he tries to claim deduction for the interest paid to the housing loan company against the interest received from the builder, obviously it's a no-brainer that it will not be allowed, because that expense of interest paid to the housing loan company has not been incurred to earn this interest. This interest is only a byproduct of the litigation that this guy entered into with the builder, and you're lucky enough to get the compensation. But he has not incurred the interest expense to earn that interest income. So that EMI, the interest component of the EMI will not be allowed as a deduction. But as far as the lawyer's fees are concerned, that certainly he can take a stand that I had to get into litigation basically to fight the builder. Right. As a result of the litigation, only I have been able to get the interest, and therefore these expenses on the lawyer's fees are incurred in order to earn that income and thereby claim that thing. But then he will have to, ensure that he has proof that he has paid the lawyer. Cash payment avoidable. Pay by check, get a bill. Many lawyers accept check, but then they don't give the bill. I'm not commenting on any. I'm just saying that this happens. Even when you go to the grocer, you pay, but you never take the bill. The fault is not with the other person. Fault is with you that you don't insist on a bill. So take a bill from the lawyer which mentions details about the litigation and the fact that it is, maybe getting interest for you, getting hardship allowance for you, or whatever it is, and then claim that interest, claim the legal fee as expense.
This is also another pretty common thing. After filing return for 2016-17 and getting a refund, I came to know that I missed to include a rental income from house property. So either people miss an expense or a revenue item. I want to pay tax on this amount in this case. In other cases, people want a deduction. What is the procedure for rectification or filing revised returns?
So under Income Tax Act, any return of income which is filed can be revised subsequently if the taxpayer detects a genuine mistake made in the return of income. There are two conditions basically for revising a return. One is that the return of income should have been filed within time. Sorry, there's only one condition. The return of income which you originally filed, in this case where he forgot to offer the rental income for tax, if that return was filed beyond the prescribed time limit. So let us say this chap is a salaried person. and he's talking about financial year 16-17, so assessment year 17-18. So his due date was 31st July. Ignoring the extensions that come because of various reasons, in the normal course 31st July is the due date. If he has filed his return by 31st July, then if he finds a mistake in the return, he can rectify it. He can revise the return by filing a revised return on the portal. At the time of revision of the return, he needs to take care that he's now filing a correct return. So he should not keep on making mistakes, because then it is obvious that it is not a mistake, but afterthoughts that are coming in, leading him to revise the returns. Revised return can be filed if it is filed in time, and secondly, there is a time limit for filing revised returns. For assessment year 17-18, the time limit is 31st March 2019. So by 31st March 2019, he can file a revised return. And at that time, what he'll have to do is that he's mentioned that he's got the refund already. So what he'll have to do is he'll have to ensure that he does not take credit for that tax already paid to the extent that he's got the money back.
He has to recalculate as if he has not got the refund.
After getting the refund, what is the final tax that he has paid? Suppose his gross tax liability was 20,000 as per the return file, and the TDS was say 30,000. So he got a refund of 10,000. Now he should not claim again 30,000 in the revised return. He should claim only 20,000.
A dependent and very senior citizen is suffering from cancer, disease allowed under 80 DDB, has incurred expenses of 3 lakh towards diagnosis and treatment. Can I and my wife both claim 80 DDB deduction of 80,000 each under section 80 DDB? What qualifies as medical expenditure? Do medicines for BP, diabetes, acidity, vitamin tablets qualify as well? Can we claim deduction under section 80D and DDB simultaneously?
So I'll answer the second question first, whether deduction can be claimed under both sections. Both the sections deal with different situations. 80 DDB talks about these serious ailments, critical ailments, and 80D generally talks about mediclaim. It talks about normal medical expenses incurred. There are different limits under both the sections. In principle, there is nothing in either of the sections which says that if you claim under 80D, you cannot claim under 80 DDB, and vice versa. There is nothing like that. So the answer to the second question is yes. In principle, you can certainly claim deduction under both the sections, but you have to ensure that you don't claim deduction under both the sections for the same amount. Meaning, under 80D, for example, the limit is, I think, 30,000. And suppose you have incurred expense of, say, 25,000. So you can't say, I'll claim 25 under 80D as well as another 25 under 80 DDD, because your total expense is only 25 and you are claiming 50,000. That is incorrect. But if you have incurred expense of say 110,000, then 80,000 you can claim under 80 DDB, provided you are covered by 80 DDB, and 30,000 you can claim under 80D, provided you satisfy the conditions given in 80D. So that is very clear. As far as what kind of expenses are covered under 80 DDB, I think 80 DDB, the intent is very noble to help people get benefit because of these serious ailments. But the procedure is so cumbersome. It's a big headache getting the deduction. You have to get the ailment certified and N number. It's unfortunate that this deduction is so complicated. I think even if you see the list of ailments, there is a problem. It's a long list, and one needs to, as a layman, you will never be able to figure out whether you have any of these ailments. Because all kinds of complicated names are there. You have to have a proper advice taken to see whether you actually have that particular ailment or disease or not. And presuming that the ailment qualifies, is covered in the list of diseases, the expenditure on medicines and vitamins and etc. should be allowed.
I'm planning to.
Sorry to interrupt. Only thing is that, as I mentioned earlier, both the sections talk about different things. What is very important to note is that under both the sections, The persons for whom you can incur the expenses, one needs to check that. Under 80D, it talks about the taxpayer, his or her spouse.
Who is taking care of?
Who is paying? The person who is claiming the deduction can claim provided the expenses incurred for himself or herself, his or her spouse and children and or parents. Whereas 80DDB talks about any dependent family member. So there is a difference. You could have a non-spouse or a non-child also as a dependent for whom you are incurring these expenses.
Sir, again, if under Mediclaim he has received certain amount, then again he should not go for 80DB for that much portion.
Oh, yeah, of course. Yeah. If you of course that will be in case of hospitalization. Mediclaim you will get only if you are hospitalized. So if you have incurred expenses, so 80D, under 80D you get deduction under 3 or 4 heads. One is the Mediclaim premium. The other is not Mediclaim premium but expenses incurred for the medical treatment of the spouse or child or parent. So if you have incurred an expense, then you get a deduction. We have not come across a case where an ITO is cross-checking whether you have got the money back. I'm not suggesting anything. I'm just saying that practically that it does not happen. But I would feel that it is only a matter of time when even the Mediclaim companies will have to start reporting online for a PAN if they have given out anything.
Aadhaar.
Yeah. If you have incurred an expense and claimed the 80D deduction and then got back the money, I would feel that it would be unfair and unethical to claim the deduction. Having said that, it's up to you to take a call.
I am planning to trade in equity futures. Is there any way to offset or avoid tax on trading by investing in tax-saving products like ELSS?
I mean, as I said earlier, F&O business is no different from any other business. If you have any business income, you are at liberty to take tax benefits under Section 80C, D, G, whatever. And so yes, answer is
as an individual.
As an individual, you can invest in an ELSS and claim benefit up to under Section 80C up to 150,000 rupees, 1,50,000 rupees, and set it off against your gross total income, which may include your F&O income, may include any other income. It is not that you are claiming against a particular head of income. I think that is a fundamental thing that one needs to keep in mind. 80C, 80D, G, all these deductions are out of your gross total income. It is not out of a particular head of income.
My wife is a physiotherapist with part-time clinic setup. Her taxable income is less than 2.4 lakhs. She is also having a demat account and a credit card. Is she required to file returns, and which form she will have to use? Also, is she required to maintain a ledger?
So first of all, this confusion is there in a lot of mind that if I have a bank account or if I have a credit card or a demat account or I have a house, am I supposed to mandatorily file the return of income? No such criteria is there. The basic criteria is if your taxable income as calculated under the Income Tax Act exceeds the threshold limit, then it is mandatory to file the return. It has nothing to do with the tax payable, it is to do with your taxable income. Why I am mentioning this is that you may have a taxable income of say 3 lakhs, which is therefore above threshold limit, but the bank has deducted enough TDS so that you are entitled to a refund instead of having to pay further tax. So the tax liability is not relevant. The moment your taxable income crosses 250,000, you need to file the return. So in this case, if the wife who is a physiotherapist does not have taxable income which is above 250,000 rupees, then mandatorily there is no requirement to file a tax return. Now the other question is, does she have to maintain a ledger, etc.? There is a section called 44AA, capital AA in the Income Tax Act, which deals with certain categories of professionals, under which certain professionals like chartered accountants, doctors, or rather medical professionals, architects, etc., are mandatorily required to maintain certain books of accounts. Now, I'm not aware whether this lady is a qualified doctor or she's just, got any other sort of diploma or degree which entitles her to call herself a physiotherapist. If she is not a qualified doctor and does not fall in the definition of medical professional under 44AA section, then there is no specific books of account required to be maintained. But in the normal course, again, you have to refer to 44AA, that even if you are not covered as a specific professional, if you have a certain level of income and a certain level of turnover, gross receipts, then it is mandatory to maintain books of accounts. So one needs to be careful when you publicly take a stand that I am in business or I am in profession. Be very careful, because there are multiple sections which may go against you and which you may not have looked at.
And what is the reason to identify a few handful of professions for 44AA?
No, so for example, for doctors, there are two sort of records that they need to statutorily maintain. One is a cash book, and the other is a daily case register. Meaning, on a daily basis, who is the what is the name of the patient attended to, etc. That daily case register has to be maintained. These two books are specific, or rather records are specifically specified for doctors. The idea is obviously to ensure that the taxpayer maintains books of account which are sufficient for a tax officer to look at and decide whether the income offered for tax is the correct income or not.
My husband was in India from 1st April 2016 to 29 September 2016, so that's roughly 6 months. He traveled to UK on 29 September 2016 at 1:40 a.m. So he was in India for 181 days plus 1.4 hours. Will he be considered as an NRI or resident for filing tax?
Yeah, this reminds me of a funny situation, a funny news I read recently, that a plane took off in 2018 but landed in 2017 because of the time zone, and was going from New Zealand to somewhere. Anyway, for tax purposes, the residential status is determined on the basis of number of days of stay in India. And for this purpose, what generally the income tax department takes into account is the thappa that comes, the stamp that comes on your passport.
Right.
So the day you arrive in India, even if you arrive at 11:59 p.m. in the midnight, that day will be considered that you are in India.
Okay.
And so similarly, if you leave at 12:01 in the morning at night, it goes the next day. The thappa will be of the next day. That day you will be considered to have been in India. So in this case, that 1.4 hours is irrelevant. That whole day that person will be deemed to have been in India. And accordingly, if it becomes 182 days, then all the consequences follow.
Right.
So it is not relevant how many hours you have been in India or how many minutes.
No, that is because it's just beyond 12 in the night, so it's 1.4 hours extra.
No, I think so basically what she is trying to say is that he was not here for 182 days.
Right.
But that doesn't sell, that story doesn't sell.
Right.
1.4 hours is not relevant.
So it's 182 in this case.
Exactly, yes.
Right.
Sir, isn't there a criteria that if you are more than 60 days in a financial year,
That is
then
that's
also you are a resident. So in this case, he is actually a resident.
correct. But since that she has not asked the question, I am not looking at that. In principle, whether it is a question of 60 days or 182 days, what is material, what is relevant
How to count.
How to count it.
But how does it work? If somebody leaves India in June, will he still be considered tax resident because he was more than 60 days in India?
Could be. It depends on the fact. So if that is in case of shippies, and there are different criteria for different situations. So yes, it would be.
I have one question on online comment from Avinash. He wants to know, can a person be considered an NRI if he stays in neighboring countries like Nepal, Bangladesh for 182 days?
So basically, it is not about staying in any other country. It is about how many days of stay you have in India. Okay. So as long as you have a stamp on your passport of departing from India, you are out of India. Now, whether you go to Nepal or whether you go to Netherlands, it is immaterial, you know. The problem, I think, is probably that in some cases, I am not sure about this, I have heard, that in some cases there is no stamp put on the passport when you enter a particular country. But according to me, when you are leaving India, definitely Indian authorities, the customs department will be putting a stamp. So the departure from India is there, and then when you come back, arrival into India will be there. So what is relevant is that. Where you have gone, I think, is not relevant.
But are there any case laws about this number of hours, 181?
Yeah, there is a case law, and that is why I said that generally the income tax department is accepting the rubber stamp, the stamp on the passport as the.
Okay, good. I have a short-term capital gain from shares. In ITR 1, if I add capital gain income and income from other source, will it get added to my total income and tax calculated based on it? What if I missed to pay the 15% capital gains tax? How do I file capital gain short-term tax in ITR 1?
So again, as mentioned earlier in one of the questions, ITR 1 is not the right form for income tax return to be filed if you have capital gain. So this the starting point itself is wrong, that I had capital gains and I filed ITR 1 is not possible. Only possibility is that the taxpayer has shown the capital gains as income from other sources, which is incorrect. He should have shown it as income from capital gains. And in fact, it is foolish to not show short-term capital gains as capital gains and instead show it as income from other sources, because short-term capital gains on listed shares you have to pay tax at 15%, whereas any other income would be taxable at the normal rate. You know, if he is in the 30% bracket, he would have paid 30% instead of 15%. So firstly, the wrong return has been filed. Now to rectify it, you have to file a revised return. What I mentioned earlier about the time limit, about the fact that the return should have been filed in time, etc., all those apply to this person also. If he has forgotten or intentionally not paid the tax, he will have to pay it now. Simple.
While paying advance tax, if all 4 installments are paid on 31st March in full, then can penalty interest be paid on 31st March along with all installments, or it has to be paid off as self-assessment tax? Also, will this interest be charged under section 243C as 1% monthly up to 31st March, that is for 8 months?
So advance tax is payable on a quarterly basis by other than senior citizens, unless the senior citizen has business income. So if you are a senior citizen without business income, you are not required to pay capital, you are not required to pay advance tax. Otherwise, normal course advance tax is to be paid in 4 quarterly installments: 15 June, 15 September, 15 December, 15 March. There are different percentages to be paid. So by 15 June, 15%. By 15 September, another 30%, means aggregating to 45. By 15 December, another 30, aggregating to 75, and by 15 March, the balance. If you do not pay as per this scheme of advance tax, then there is an interest, as rightly mentioned by the queries, under section 234C. And so there are 2 sections under which interest can be charged for default of advance tax. One is 234C, which he has mentioned. Another is 234B. 234B is payable if the advance tax is not paid at all before the year end. But if the entire advance tax is paid by 31st March, then 234B will not apply. But 234C will still apply if the sequence is not followed. So let us say my total tax liability for the year is 100 rupees. By 15 June, I should pay 15 rupees. By 15 September, I have to pay another 30, so total 45. And then 75, and then by 31st March, 100. By 15 June, if I don't pay 15 rupees, then on 15 rupees, I'll have to pay interest at 1% per month for 3 months. By 15 September, if I have not paid 45 rupees, in this case he has said I have not paid at all. So that means he has paid 0. So my default is 45 rupees. So on 45, another 1% per month for 3 months. By 15 December, 75 I should pay, I have not paid. So on 75, 1% per month for 3 months. And so on and so forth. That's the way interest is payable. By 15 March or 31st March, if the entire advance tax is paid, you have an option of paying the interest that you calculate under 230. Interest will still be payable. You can either pay it upfront or you wait at the time of essay tax, at the time of filing the return. That option is optional.
And 234B?
No, so 234B is payable if you don't pay any advance tax before the year end. After the year end, you have the option of either paying it immediately, so that your meter stops, you don't have to pay further, or you pay it at the time of filing the return.
I have taken a housing loan and filed ITR 3, earlier ITR 4. I have figured out where to put the interest amount for a financial year in the Excel utility available at incometaxfiling.com. However, I am not sure where to put the principal amount in order to claim tax benefit on the same. Could you tell the correct sheet to put this amount in ITR 3 Excel utility?
My advice would be, come to me and we'll make your filing. But leaving aside the lighter note, this is getting into a specific part of the income tax return form. In the normal course, we would not entertain such queries, but here my team has told me where to go. So in ITR 3, in the Excel utility, you have to go to a sheet called 6A sheet. The deductions for the housing loan repayment is under section 80C. 80C section is part of chapter 6A, and therefore this sheet called 6A sheet. In that, there is you have to select the deduction for repayment of principal amount of housing loan, which is repaid in the cell called G3, and claim the benefit.
So this is normally a blank form with all the heads, so he can find it on his own.
Yeah, there will be drop-down menus.
So one has to explore, that's about it. I forgot to reply a query from Income Tax Department under section 143(1) within 30 days, as my mail ID has been hacked. And now when I check income tax website regarding my income tax return, no submit button displaying on e-proceeding section. What should I do to reply?
Well, there's a problem because the department gives you, the CPC, the e-filing portal gives you 30 days to reply. If you don't reply, that feature which allows you to reply is disabled. So then there is no way you can give a reply on the portal. But the person is not given the details, further details of what question or which year, etc. I'm presuming that this is relating to assessment year 2016-17 or 17-18, and the question was relating to mismatch of income from salary as appearing in the salary, the TDS, the form 16 issued by the employer, and what the person has shown in his or her return of income. Some months back, there were wholesale on a wholesale basis, salaried people got these queries. The reason was that the CBDT had instructed the CPC, the Central Processing Center, to do this. That you compare what the salaried taxpayer has shown in his or her tax return under the head salary for every item of income and exemptions and deductions, and compare that with what the employer has shown in the TDS return for every employee. So for example, to illustrate what I'm saying, if the employer has shown that he has paid me salary and has granted an exemption of 15,000 for medical reimbursement, has granted an exemption of say about 9,600 for conveyance allowance, and so on and so forth. Have I shown the same figures in my return that my conveyance allowance is exempt to the extent of 9,600, medical reimbursement is exempt up to 15,000, etc. or not? When an employer is filing the TDS return, they also need to show how much Chapter 6A deductions they are allowing to the employee, 80C, 80D, etc. Whether that amount which employer has shown for me is matching with what I have claimed in my return. And if it is not matching, the CBDT had told CPC to inquire into this, and that is why CPC had raised the query. There was a big hue and cry in this matter. We took it up strongly with the CPC and with the CBDT, and finally CBDT relented and they have withdrawn all those questions. So if this person had got that kind of a question, he did not worry. His return would have been processed and return income is probably accepted. But otherwise, if there was some other query and he has not responded, too bad. You have to follow the law and reply to them within the time. At the most, what he can do is file a reply with the jurisdictional tax officer. However, I don't know how much that would be of help. But at least his bona fide is established that I have filed a reply physically.
I am earning interest on fixed deposit in my own bank account. If I open an HUF account, will HUF entity pay tax on FD interest, or will it still have to be paid by me? I will not be transferring any FD interest to HUF bank account.
I can't understand what is the whole objective of forming the HUF if the income is not getting sort of transferred to the HUF. The person who asked the question is saying that I am earning interest on FDs, which I am offering for tax in my hand. Now I have an HUF. Can I show the interest in the HUF's account and not in my account, even though the FD continues in my name? The answer is obviously no. The person who earns the income has to offer it for tax. So there is no question of the HUF showing that income in the HUF's return.
My father is planning to sell his property and utilize some part of the money, around 70%, to repay my home loan, and the rest he will invest in buying a new property. In this scenario, I would like to know what are the tax implications.
No, so unfortunately there is no fungibility between family members in India, unlike USA, where, for example, in USA husband and wife file joint returns. In India, everyone is a separate taxpayer. Everyone is treated separately by the income tax department. So if the father sells his house and instead of investing the entire capital gains in a new property, if he uses some portion of the capital gains for other purposes, whether to repay a housing loan or for whatever, then to that extent the exemption that he can claim will be lower. There is nothing to prevent him from using his money for any purposes, but the exemption will be restricted.
I have one question which is asked online, and it's been asked repeatedly as well, that lots of people have got notices about investment in cryptocurrency and bitcoins. So first of all, if they're illegal, then what is the point about how is the taxation going to be done?
Well, first of all, I don't agree that it is illegal. I don't think it is illegal.
Yes,
in any case, sorry?
No.
Even if it is illegal, so if the question is that, and which question appears to have been asked by several people online and even at other platforms, is that cryptocurrency related people who are dealing in cryptocurrencies are getting notices from the income tax department, and the questionnaires are, extremely detailed. There are 2 pages full of questions being asked. So the question is that if it is illegal, then how can income tax department, how do they step in? So first of all, we have to understand income tax department doesn't care whether it is legal or illegal. So without getting into the question whether it is illegal or not, the point is, so for example, if I am doing smuggling, that doesn't mean that I should not offer my income for tax. If I am doing gambling, it may be prohibited by the law, but it is still taxable. Income Tax Act is neutral about the source of income.
Correct.
If it is income which is covered within the scope of taxable income under the Income Tax Act, you have to offer it for tax in your income tax return. So coming to cryptocurrencies, leaving aside the issue of illegality, if there is income arising from cryptocurrency, you have to offer it for tax. All other questions which affect any other normal income or rather any other asset, that is it capital gains or is it business income, etc., will apply to cryptocurrencies also. If it is in the nature of an adventure, if it is like an adventure in the nature of trade or business, it will become your business income. You have to offer it under that business income. If it is one-off or it is not your regular business, but you are able to prove that it is only my capital asset, I am investing in it as an investment, then income from that will be considered as capital gains.
There's a question. There are a couple of 3 questions by Mr. Datar. So I'll read them out. They are last ones in this list. There are 3 major types of pension: annuity, post-retirement, immediate annuity, annuity after some period. Which of these is taxable?
So Thank you, Mr. Datta, because you made me read some sections which we generally never read. As far as pension is concerned, there are two types of pensions or two ways of getting pension. One is commuted value of pension, and the other is the uncommuted pension. Commuted pension means you get a lump sum amount, and uncommuted means you get it like an annuity on a regular basis. So as far as the uncommuted pension is concerned, uncommuted pension received whether by a government employee or a non-government employee is fully taxable under the Income Tax Act. There is no exemption. The commuted pension received by a government employee is also fully exempt from tax. So that leaves commuted pension received by a non-government employee. In case of non-government employees, normally the general rule is it is taxable, but there are certain formulas given for calculating how much is taxable. So it is taxable to the extent it does not exceed certain A, B, C, D, E. I will share that through email instead of getting into the nitty-gritties. In principle, it is taxable subject to certain arithmetical formula. And the commuted or lump sum pension, if it is received by a family member on the death of the assessee, then it is exempt. So that is one. And lastly, uncommuted pension received by a family member on the death of the employee is exempt. Again, it is exempt, but subject to a certain limit laid down in the Income Tax Act. So these are the broad rules for taxation of pension. You have to see whether it is commuted or uncommuted. If it is uncommuted, it is taxable in all cases. If it is commuted, it is exempt in the case of government employees, and it is taxable in the case of non-government employees, subject to certain limits.
Your next question, apart from insurance companies, mutual funds too have different plans. Is it regarding pension?
Yeah,
pension plans.
Yes.
What is the tax implication?
So it doesn't make any difference whether you are doing it through an insurance company or through a mutual fund. The principle is same.
We put our own money in some mutual funds and opt for systematic transfer plans or systematic withdrawal plans. Here again, we have a choice to choose fixed in amount or number of units. Depending upon the market conditions, it's quite likely that these options may generate some capital gains on transfer or withdrawal. Also, we are partially withdrawing our own money. So is it taxable, and in what manner? In short, whether this will be treated as income or capital gains or both.
So first of all, whether it is income or capital gains, according to me, is not the right question, because capital gains is also income. The question is whether. So let me answer it by giving an example so that it becomes clear. You have put in. First, let us talk about the systematic investment part. So you have put in, say, an SIP of 5,000 rupees per month into HDFC's some balanced fund, mutual fund. So every month from your bank account, 5,000 goes in. You obviously know as an investor that when you invest on a staggered basis, obviously the NAV is going to be different on different dates. So first month when you invest 5,000, let us say the NAV is say 11 rupees. So if your 5,000 divided by 11, whatever is the number of units, you will be allotted those many units. You will get a mutual fund statement. Next month you put in another 5,000. The NAV could be 11.05 or whatever it is. Let us say 11.05. So 5,000 divided by 11.05, the number of units will change. So that way every month different number of units are getting allotted to you. And for every batch of units those which are allotted, the date of acquisition is different. That we have to keep in mind, because ultimately when we redeem the units, that is when we sell the units, we have to find out whether it is long term or short term. For that, what is relevant is the date of purchase. And for every month so every month's purchase is a different date of purchase. So therefore, first advice in this kind of situation, where if you are doing an SIP for investing purpose, please keep all the mutual fund statements safe. Don't think that, you know, is a piece of junk coming here, or you get irritated with that CAMS or NSDL sending you. They are doing their job. You will require it when you sell. So keep all the statement, because you will need to find out whether to find out whether it is long term or short term. You will need all those statements. Okay. So that is one. Secondly, now let's go to the other side, that you, instead of after having invested for a reasonably long period of time, you have say 50 lakhs amount invested is 50 lakhs, for example, whether by way of SIP or whether by one lump sum investment. But after reaching a certain age, or for whatever reason, you want to start getting the money back, you start withdrawing. That is systematic withdrawal plan. So all the mutual funds have now started offering this, that you can withdraw on a systematic manner and get every month 5,000, 10,000, whatever you want. When you withdraw, from your perspective, you are withdrawing 10,000 or 5,000 or 50,000, whatever is the amount. Okay, in terms of money. But for tax purposes, that is irrelevant as to whether you have withdrawn 50,000 or 1 lakh or 10. What is relevant is how many units you have sold. So when you redeem at the end of every month 50,000 rupees worth of units, the number of units which are getting redeemed will be different every month. Just as when you invested, it was different number of units getting allotted. The redemptions are also happening in respect of different number of units. So what is relevant is how many units you have redeemed, at what price. That is the sale consideration. Say 50 units sold at X price is the sale part, and the date you know, say 6 January 2018. Now you have to, for calculating capital gain, you have to go back in history on a first in first out basis and find out when did you buy those 50 units. 50 units you could have bought 10.3 units on 1st January, another 10.2 units on 1st February, and so on and so forth in say 2013. You will have to keep track of all those purchases, find out finally how much is the cost of the 50 units that you have now sold to get that 50,000 rupees, and calculate the capital gain. It is possible in this kind of situation that some portion of that capital gain may be short term and some may be long term. It all depends on when you bought them. I hope I have answered.
Yes.
So again, the focus is on documentation. Keep all the mutual fund statements. We are getting soft copies. There is no need to keep hard copies. You keep soft copies, but when you sell, you will require this. Without these statements, it will be impossible to calculate the capital gains before we come to. Another similar issue arises not in SIPs or SWPs, but in dividend reinvestments. I'm taking completely different question. I'm not
Very important.
Not a question, but it is important. There are even daily dividend schemes, which is ridiculous, because then you have to keep track of 365 dividends declared in a year. Every dividend declared and reinvested gives you a different number of units. Of course, generally in liquid funds or in money market funds, the NAV is more or less same throughout the month or throughout the year. So to that extent there is no problem. But otherwise, every month NAV is different, number of units allotted are different, dividend declared is different. The big headache at the time of sale to tell your CA that I have sold 100 units and my cost is what? The CA will have to sit with n number of statements to find out what is the big headache for us when we get this kind of time. Therefore, one needs to be very careful.
And the same first in, first out applies to shares as well.
Everyone. He had a question.
So I do invest and trade a lot in equities. So I do maintain a record of all the contract notes, but not of the CDSL statements which I get at home. So is that fine, or should I start keeping a record of that as well?
So as far as documentation is concerned, it is never, you are never having enough. It's never enough. Whatever you have, as much as you have is better. What ultimately, why do you maintain? Why am I saying keep documents? I'm saying keep documents to prove A, when did you buy it, how much did you buy it for, when did you sell, and how much did you sell for, and STT paid hai कि नहीं hai. As long as these facts you are able to prove with whatever documents, you are okay. If you have 2 documents to prove the same thing, you are even better,
What I've often seen is that people know the law, but they know the law in their own way. There are nuances in law which you don't know about, and you're not bothered to keep track. For this little point that you mentioned, whether STT paid or not, this is such an important thing. You may be thinking that I have all the demat statements. Can you prove that you have STT paid?
Exactly.
Then you need the contract note.
Absolutely.
So it's you will thinking that I have enough documentation, but you may not have it.
So your question is, I mean, for me, if you were a client, you're a nice client because you have the most important document, the contract note. There, on the other side, people may come, I have kept demat statement and not kept the contract. That is the most worst thing to happen because demat statement doesn't give you value. It gives you only quantity. Okay. Sometimes they may give you the value of your holding as at a particular date, but it does not tell you how much did you buy it for.
And whether you paid
So only demat statement is not enough. Demat statement with contract, fantastic. Only contract, okay.
So on that second question, actually, frankly speaking, my wife is bothering much. She has put lump sum and she says, I am withdrawing my own money, why should it be taxable? But then I have to convince her now.
That's why
The law doesn't care about good and bad people.
No, when it's a question of convincing a wife, the husband should never try it. Get external help.
That's a good one. The last question, and also from Mr. Datar. One of the most common misunderstanding is that since I have submitted 15H and 15G, the bank should not recover TDS. In fact, if all the deposits are kept under the single customer number and also linked to PAN, if the total yearly interest is going to exceed the present limit of 3 lakhs, the software ignores the submission of 15GH and recovers TDS as applicable. We need to educate our members.
So I don't know whether you were present, but in one of my presentations here only in this room, we had one slide only on 15G, 15H because it's very complicated. Most people have no idea whether they are actually supposed to give 15G or 15H or not. And more than the people, the banks definitely don't know whether they should be accepting or not. Sometimes they force the depositor to give a 15G even if he or she does not want to give. In my own sort of mother-in-law's case, I told her not to give the senior citizen that 15 G form, and the banker insisted. The clerk sitting there, no, until you give. She was forcing that my mother-in-law to give. So that's why we had a slide as to why it is important to understand when 15G or H is supposed to be given, and when you are not allowed to give. So you may have given, but you are not actually supposed to give. So as far as 15G is concerned, it is applicable for non-senior citizens and 15H is available for senior citizens. 15G is to be given only when the final tax on the total income is nil. The final tax on the total income is nil, meaning, in short, your income is below taxable limit. And secondly, the aggregate of the interest and, in short, your gross total income does not exceed the basic exemption limit. Now, this is where most people make a mistake. So, to give an illustration, suppose I have only bank interest, okay, so which therefore gives rise to the question of giving a form 15G to the bank. I have only bank interest, my bank interest is 3 lakh rupees, okay, and I have put in 40,000 in PPF account, okay, so my gross income is 3 lakhs. I have put 40,000 in PPF, so I get 80C deduction of 40,000, and I get 10,000 deduction for bank interest under section 80 TTA, savings bank interest. Yeah. So 3 lakhs income, 40,000 80C, 10,000 80 TTA, 50,000 gone. So 2,50,000 is my total income under income tax act, which is below. It does not exceed 250,000, so it is below threshold limit. So I don't have a tax liability. Normal understanding by a person would be I can give 15G. The correct position is I am not allowed to give it 15G in this case because my gross income, my gross total income before chapter 6A deduction is more than 2,50,000 rupees. So this is one. As far as 15H is concerned, senior citizens, for them it is luckily different. they can give only the final tax liability on the total income is nil for them. So therefore in the same situation, example, 3,40,000 and 10,000, if I was a senior citizen, then I can give 15H. But if I am not a senior citizen, I can't give 15G. That is, the theory. About the different banks and, the PAN being linked to various, so obviously because of these limits, taxpayers become smart, they try to divide the FDs among different banks, among different branches, etc. and try and give 15G everywhere, even though the income is above taxable limit, and they try to escape the TDS provisions. It won't work now, because A, whether he likes it or not, Aadhaar, PAN, everything is linked to the bank account. And all the banks are on.
Even if Aadhaar was not there, this was not possible because it's linked to PAN.
Absolutely, yeah, correct. So PAN, okay, let's control or delete about the Aadhaar.
Exactly.
The PAN is linked to your bank account. The PAN is linked to your fixed deposits, and there is a common, sort of database available. So if the interest on the bank, whether savings bank or FD interest, from all the banks put together exceeds your 2,50,000 rupees, then there is no way you can give 15G. Even if you have given, the bank has every right to ignore it, because your income, you are not supposed to be giving it. That's, I think, the answer to your
Very, very clear. Thank you.
We have online query from Parthiv Kantawala. He says, I have income of 25 lakh rupees, out of which I am donating 20 lakh to a political party. Will that be a problem?
Why not some to Moneylife Foundation?
So answer to your question is, donation to Moneylife doesn't solve any other problem. But problem for the political party or for the Mr. Katawala?
Mr. Kantawala. He says, will the ITO question that the...
Well, so there are two things. One is, on an income of 25 lakhs, he is giving donation of 20 lakhs. He can give a donation of 25 lakhs also. There is nobody can prevent him. I don't think anybody can question you, okay, as to why you gave donation, whether to political party or to anybody else. Like, on the other hand, if you give 25 lakhs to Moneylife Foundation, why should anybody question you? It is your money, tax-paid money. You can do what you want with it. You can tear the notes and throw it away, as many people did with the 500 and 1,000 rupee notes, because they were useless. So that the ITO cannot question why you gave a donation. The suspicion that an ITO may have is that this guy is earning 25 lakhs, he is giving away 20 lakhs, how is he maintaining his family? That suspicion is valid. He has every right to question this person, to find out that, what is happening actually. He may, for example, ask that Mr. Katawala that you give me your bank summary, you give me a details of your household expenses, how much are you spending per month. Now suppose his household expenses are, say, 70,000 a month. 12 into 70,000 is 8 lakh 40. He earned 25 lakhs, gave 20 to XYZ party. He was left with 5 lakhs. How did he spend 8 lakh 40,000 on his household expenses? So that care needs to be taken. Otherwise, I don't foresee it.
And he doesn't get this 20 lakhs doesn't qualify for 80G or whatever.
Exactly.
No. So senior citizen and government pensioner, suppose he is doing some small petty business, he is required to pay advance tax, or whether that ITR or one form will do, or just in another form?
So, as I said earlier, at the time of explaining the advance tax provisions, so let me first repeat his question. A government pensioner is doing small business, petty business. The question is whether advance tax is to be paid, and secondly, whether, or rather, which ITR form is to be filled up. If you have business income, irrespective of whether you are a government servant, a government pensioner, or whether you are a senior citizen or a junior citizen, whoever you may be, if you are having business income, you are in a different league altogether. Okay, the exclusion or the benefit given to a senior citizen not to pay advance tax is only if you do not have any income chargeable under the head profits and gains of business or profession. If you have business income, you need, and then if you are, your tax liability is more than 10,000 per annum, you will have to pay advance tax. If you have business income, then naturally you cannot file ITR 1 or ITR 2, you will have to file ITR 3.
So one more question. There is any difference for senior citizens past 60 years and past 80 years?
Yes, senior citizen, so a person above the age of 80 is called super senior citizen, and between 60 and 80 is called a senior citizen. So above 80,000, above 80 years of age, the threshold limit is 5 lakhs. And for below 80 but above 60, it is I think 3 lakhs.
We have Ritesh Gulrajani online. He wants to ask, we are genuine taxpayers and feel cheated as we are taxed twice as per our income tax slabs and then on GST, grocery, restaurant bills, which are not allowable expenses, where many businesses incur expenses of personal nature and put it in the business. A known fact, but nothing has been done to reduce taxes. Is there any way to send a complaint to the IT department with the names of the companies? Aren't these low-hanging fruits?
So Ritesh, if he's listening, I would tell him, when you meet me personally, let's discuss. You don't need the Moneylife line. But it is wrong to say that nothing is being done by the income tax department or by the government in respect of bogus expenses. That's a misconception. It is very easy for any common man to say whatever he wants, thinking that no action is being taken. We go to the income tax department, we are seeing what kind of questions are being asked. They are definitely going into the reasonability and the genuineness of the expense.
In fact, not a lot of people complain that even genuine expenses are added back to income, and we have suffered that as well.
Correct, yeah. So when there is a quota system, and when the officers are given a target of to be achieved in respect of revenue collection, all these kind of things will happen. But coming back to the basic issue that he has raised, that common man feels that he is paying income tax and then he is paying GST and therefore he is paying double taxes, whereas other people are escaping, or getting away with, whatever. The grievance is justified, because we all know that there are a lot of tax evaders in the country not paying taxes genuinely. But that does not mean that the government should not levy the GST or not levy the income tax. That's a completely wrong way of looking at it. The focus definitely should be to catch the tax evaders, which is now what is happening. We are clearly seeing that. The fact that the number of returns being filed has increased in the country is a clear indication that a lot of people have got the message that it is no longer safe to evade taxes. Now, it may be possible that all those who have now come into the tax net new are not showing the whole income for tax. But they will realize that as time passes and as the data analytics get stronger and stronger, I am convinced that because of so we need to go back in the last 2-3 years, what are the steps taken by the government, whether it is demonetization, whether it is Aadhaar, whether it is the linking the bank account, what are those banks, Jan Dhan accounts, etc. All those steps are clearly aimed at ultimately getting people into the mainstream economy, into the not only the tax net but into the formal economy. Once you are in the formal economy, in today's age of technology, there is no way you can escape the eyes of the income tax department or the indirect tax department. So as the compliances become better, I am confident that the grievance which Ritesh has and which thousands and lakhs of other people have will get reduced. Definitely, it will not go away. You will still see a guy getting into a Mercedes and getting into a 5-star hotel and freaking out, and maybe he is not paying tax or paying less taxes as
or charging to the company.
But the reduction is clearly there. The compliance has definitely improved in the last 2-3 years.
It's my feeling. I can see the technology is doing a good thing in income tax department, but there is an income tax demand notice for me issued by some other ITO, which I don't know. And my own ITO says there is no outstanding tax demand, but still I am not getting my refunds. I had filed n number of complaints, n number of grievances.
Did you file RTI?
No, I wrote to the income tax ITO who had issued the notice in AY 2008-2009, but he has passed on the buck to my current ITO. Current ITO says there is no outstanding tax demand, but still my refund has been adjusted now. what to do.
Adjusted by CPC.
Just by CPC, I got a note from SBI.
So this is there are two things. One is the technology part, okay, and the other.
I mentioned because there is a provision to submit your response. I had submitted response, disagree with the demand, and I submitted response for 8 to 10 times.
Yeah. Okay. So one is the technology part. The other is the physical part where the demands are uploaded onto the system. That is done manually. In the specific example that you gave, it is clear that the demand is manual demand, uploaded by some officer, and the adjustment is done by the technology, because technology is blind. Technology doesn't know Yogesh Sapkale's genuine problem or a non-genuine problem. It is configured to straight away adjust. Demand here, refund here, adjust. Debit and credit has to match, basically, somewhat like that. So keep aside the technology part, because technology will not help you, because till such time as the other part of technology shows a demand, they are not going to be able to do anything. The key lies in getting the physical demand knocked off. You said you have written letters. Writing letters in our country doesn't work. You will have to go and take a holiday from Moneylife. Go there one day, sit over there, irritate him, fight with him, do what you want. Unless you go and sit and get it rectified, it will not get rectified.
No, the funniest part is for the same assessment year, my ITO has
issued a refund.
Absolutely. I received the refund also.
Correct.
So there is no outstanding.
So I also had a case where I got a refund and now the demand is being raised. So these are funny things that happen. You have to go and sort it out, get it rectified physically. If you go once, if you go twice, if you go thrice, third definitely they will do it, because they also know that people are suffering.
No, but his ITO, I am not concerned with the ITO. I am never been into his jurisdiction. So how he can issue a demand notice for me? The ITO
I don't know.
Nanded. I was never in Nanded.
No, so then, and that's this peculiar problem. It's not a generic problem. We have not come across this kind of, where some other officer has uploaded, it has not happened. We can take it offline. Theoretically I can't give, I've told you what can be done, but if there is a different officer who has no jurisdiction over you, then there is something else is wrong.
I think RTI will do the trick, because there are a lot of stories on the net. With one RTI application, refunds come, all kinds of things get sorted out. So you should do that.
And I'm not sure whether you use the PG portal.
No, I use the income tax portal only.
So try PG portal also, because whenever we meet the commissioner level officers in the public meeting, where these people call public meetings where they call representatives of taxpayers. Whenever we have gone there and complain about this kind of thing, they themselves tell us, you complain on PG portal, which is Prime Minister's office is monitoring it. Action apparently takes place if PG portal gets a complaint.
Have you heard this?
Okay, so I think you'll take it offline, because it's 5:30. We start on time, we'll end on time. He's here. He's right here. Okay.
So there was in the TV channel 3-4 days back. There was a news item that from 1st January 2018, the scheme has come. If the amount is less than 2,000 rupees, and if you pay by credit card, you do not pay the tax. Was he meaning the GST? I don't know.
It's the India.
It's the India discount rate.
Valid for 2 years, they said.
No, it's nothing to do with taxation. It is the money that merchants are supposed to pay. That rate they have reduced, so that more digital transactions, more credit card transactions can happen. It's nothing to do with income tax.
I was telling you did not pay the tax.
No, nothing to do with tax. Okay, so thank you very much for all those who have sort of listened to us on the Cyberspace Facebook Live. Please give a big hand for Ameet, who's very generously once again given time for Moneylife Foundation members. Hope we can do this sometime in future whenever you have the time as well. Okay, so thank you very much. Thank you.